It's it's the same thing that happened in 2008. Yeah, and exactly as you said, banks didn't want to lend to other banks because they didn't have the money. Well, that's the same thing that happened in 2019. That why did interest rates go to 10% for a day in 2019? Well, because there weren't enough dollars going around. And so if you look at the money supply, if you look at, you can look this up, or your viewers can look it up at the M2 money supply, it's been falling since April 2022. It's never fallen for this long at a time. And the only reason that it hasn't crashed the system yet is because there's still extra money in the system, about $850 billion of it, and that's draining out. So 12, 13 weeks from now, I think it's going to be at zero. And then we're going to be in the same situation as 2008, 2019, 2020, 2024. It's always different as to how exactly the dominoes fall. And another one of them could be Japan, which is, people are speculating now they're going to end their yield curve control, which means their bond yields are about to rise significantly, and the yen is backed 80%, I think, by bonds. On the balance sheet of the Bank of Japan is, I think, 80% bonds. I could be wrong on that number, but it's some really, really big number. So when bonds fall, the other side of bonds, if a central bank owns bonds and they issue the currency, the other side of the bonds is the currency. So if the bonds fall, the currency falls. That could be another a major domino that causes some kind of hiccup or earthquake in the U.S. banking system. It's all connected. We're all in one really global banking system with different flavors, with different currencies, but it's all the same principles. It's all the same fractional reserve nonsense, and it's all going to fall together.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Rafi Faber, who's an endgame investor currently on Seeking Alpha, but moving to Substack soon, I've heard. So, Rafi, thanks so much for coming on the podcast today.
Thanks, Anthony. Good to be back. It's been a while.
Yeah, it's been, I think last time we talked was sort of during the banking crisis earlier in the year. And a few things have changed. And it's quite interesting when we look at it. Like, people seem to have forgotten about that. They're saying everything's okay. Fed have landed the plane, economy's growing, equities are up, gold's up, bond yields are down, everyone's happy. What are you currently seeing? Do you agree with, I guess, all this rhetoric that's going around?
That everything's fine. Just ask people in the street if they think everything's fine. I hear that people are struggling to make ends meet, and inflation is ravaging everyone, including me, probably including you too. It's especially bad in the UK, I heard. With the way that that Keynesian economics structures an economy, when you print money, things seem like they're doing better. And though money isn't being printed right now, there's still more money coming in from the printing of 2020 and 2021, which is keeping the banking system from completely collapsing. But we already saw back in March that it started to collapse, and it's going to get much worse until the Fed starts printing money again. And when they do, that might be it for currencies, because they're going to have to print, what was it last time? It was like $4 trillion in a few weeks, or 2 or 3 trillion. I lose count, but and so this time it's going to have to be more, because when more financial institutions have more money, they lend that money out. When you print money, they lend the money out and they go into debt more. So they need more money to pay back their own debt. You need to print more. And that's why everything goes on an exponential curve in this monetary system. And we're about to head to the vertical portion of that any month now. It could be any week now. Can't give an exact time, but I'm pretty sure it's going to be in 2024. That much I can say confidently. And I could even be wrong about that. I've been wrong before, but I'm pretty confident about 2024.
Okay, that makes sense. So you think it's all coming to the end. And I know we talked about, to start with, sort of repo markets, but before we went online, so the repo markets, and you've been talking about a lot about that. So I guess, can you maybe explain what they are for the audience, and then why they're important?
Yeah, well, now I was talking about reverse repos until a few days ago, when I started paying attention to the repo markets, which is the reverse of reverse repo. Basically, repo is when a bank exchanges treasuries or government securities or whatever country you're in for cash that they need to settle the day. A reverse repo is when a bank has extra cash and they have no one to give it to, so they give it to the central bank in exchange for treasuries, so they can settle the day with less cash, because it costs money to hold cash and it costs less money to hold treasuries. So the from around 2021, late 2021 to now, there have been no repos, meaning no repos directly with the central bank. There have been repos between banks, but the central bank hasn't been involved because some banks have extra cash that they can lend to other banks that have not enough cash. But in terms of the extra cash in the system that couldn't be lent to other banks that were short on cash, the extra went to the Fed in exchange for securities that the Fed gave to, or whatever central bank that the Fed gave to that bank that gave it cash. So that's extra cash that couldn't be fit into the banking system during the printing sprees of 2020 and 2021. And that's ending now because all that money is being drained into the Treasury to finance the debt of the U.S. government, which is insane. Now it's like I think the national debt is going up like $1 trillion in some very short amount. I want to say 30 days, but even that sounds crazy to me. Is it something else? Is it like 60 days? Whatever it is, it's like it just keeps going faster and faster. And all the money that the banks have been handing to the Fed because it's extra, now they're handing it to the Treasury so the Treasury can, I don't know, bomb Ukraine or buy bombs for countries that bomb Ukraine. You know what I mean? No, sorry, it's the wrong one. Wait, so that Ukraine can bomb other okay, are we gonna leave that in?
Yeah, it's fine.
I forget who's bombing who these days. For bombs, they like bombing, so that they have to spend a lot of money. That's running out now, and when it runs out, I don't know who's going to fund all this debt because interest rates, even though they have gone down in the last few months, they're still much higher than they have been since 2008, which they were like just constantly zero from 2008 to 2020. And now they're like between 4 and 5%. So when that extra money runs out, who buys these treasuries? I don't know. So I think the Fed's going to have to buy them, which means it's going to have to stop quantitative tightening and start printing money again. And when that happens, I think the precious metals really start to move higher. The fact that we hit a new high in gold without the Fed turning around and with the money supply still falling is significant enough to say that there's a lot of hidden strength in gold right now. And imagine what happens when they start printing again. It's going to go berserk.
Yeah, it makes sense. So when you're saying the reverse repos, you're saying it's something that banks put their excess capital into it. So the fact that they're withdrawing means that maybe they're having capital constraints somewhere. Is that sort of what you're thinking is happening?
Well, they're running out of extra cash, and instead they're giving it to the Treasury. On the other side, you have the volumes in the repo markets. Not that the Fed is involved in that directly yet, but repo between banks, the volume in that market has spiked. I think by like $500 billion in a few months, and we're at all-time highs. I think the all-time high was like $1.85 trillion in a night, and we've seen before when there are spikes in overnight loans between banks. When volume goes to new highs, that means there's some stress because it means a lot of banks are short on cash, or else they wouldn't be borrowing it, right? So that happened in September 2019 when repo rates went to about 10%. That means the rate at which a bank would lend cash to a bank short on cash was about 10% in exchange for treasuries. And that signaled that there wasn't enough extra cash, there wasn't enough cash in the system. So the Fed had to print. It stopped quantitative tightening there and expanded its balance sheet. So it looks like we're on the verge of something like that again. It could happen around the year turn when there's generally a spike in the repo market volume. But I think it's going to happen when the reverse repos run out and there's no more extra cash anywhere. Then we're going to go into the next printing round, and however much consumer price inflation is, what people call inflation, what I call just rising consumer prices, however much they're rising, all central bankers are going to have to print at the same time. It's not just the Fed, because when the Fed prints, all other central banks have to print too, or else the exchange rates between currencies go out of whack, and then all these economies get disorganized, and the heavy interests, the special interests that the exporters that have a lot of political power or clout, they tell their central banks what to do, behind closed doors. So all central banks have to print or drain at the same time. So when the Fed prints, everyone prints, and then all currencies fall at the same time.
Yeah, okay, no, that makes sense. And I guess maybe the banks are, you could say that yields have gone down, so the value of bonds have gone up. So maybe they're, I don't know if they're selling bonds now at a better price to try and increase their liquidity. But there could also be the risk that, as is, they're still deep in the red. So maybe they're hanging on to these bonds, and if they're forced to sell, that's when we could see yields going down further. Then there's going to be more risks in the banking system, it seems.
If you meaning if the Fed is forced to sell, wait, who
I
is
think
forced to sell?
if actual banks are forced to sell, then that could bring more turmoil. Sort of similar to what we saw in March this year.
Oh, right, right. So yeah, that's interesting. That um there is this phenomenon that there is increased liquidity in the system right now, which means increased reserves. And the question is, so if it's tight in the repo market, but banks are holding on to this excess liquidity, they don't want to let go of it. Why are they doing that? And I think it was Mark Cabana of Bank of America, who's one of the head bond guys in Bank of America, like really happy. He's in the news a lot. And he says, why is there extra liquidity? He says because that banks are holding on to it because if there is a liquidity crunch and then people start withdrawing cash or taking money out of the banks some other way, then banks would have to sell assets in order to meet those redemptions. And there's the unrealized losses on bond portfolios for banks, which is what brought the regional banks down. They're in the, I think they're like $500 billion across the banking system. So if a bank that has unrealized losses on its bond portfolio is forced to sell to meet withdrawal requests, then those unrealized losses become realized losses, and the bank is in real trouble, and the Fed really has to bail them out. So, yeah, if they're forced to sell bonds in a liquidity crunch, the Fed is definitely going to have to step in immediately, and it's just a matter of time. It's absolutely going to happen, and again, I think it's going to be 2024, probably early, probably when the reverse repos run out, or sometime around there.
Yeah, no, that makes sense. So if we look at what happened earlier this year, the Fed came in, they saved the world. They created this new system where they could basically give banks more money. And it sounds like you think that something similar is going to happen, where they're just going to continue to print more money and put it back into the banks to try and keep the current system going.
Yeah, it's all the same pattern every time. Whenever you print money that's unbacked, then people go into debt and they need more of that money to service that debt. And eventually you run out of the money because you stop printing it, and then somebody goes bankrupt and that causes the next bankruptcy. And it's always a chain reaction until you print more and you make the wave even bigger. So we're just waiting for the final round of this. The question is it going to be the final one, or is there going to be another one after that? I think it's going to be the final one. I could point to a lot of things, just the complete insanity of society, the wars everywhere. It's just getting to be a very, very dangerous world. I live in a war zone, and I blame a lot of that on money printing because it drives governments crazy, makes them think they can do stupid things, and that's what happens. So I hope we're in the final round of this, because it's going to get even more dangerous if we're not. And it's going to be tough, but clearing it out is what needs to happen.
Yeah, I think a great example of that is what's happening in Venezuela at the moment, who are trying to invade Ghana or something like that because of, and as you said, they've got ridiculous amounts of inflation, and that this is a way for them to try and move the message from their economic issues to conflict.
Oh, really? Venezuela is invading Ghana? That reminds me of when Italy invaded Albania. I think it was like King Zog or something. I think Mussolini wanted to impress Hitler, so he's like, I'm gonna invade Albania, and then Hitler, like, clapped for him, and then World War II started or something like that. I don't know the history exactly, but I know there was some kind of minor invasion there that was like a preview of what was actually going to happen.
Yeah, it does seem like that. There's just more conflict happening all over the world. So another thing you mentioned is the secure overnight finance market. So I guess we sort of covered it with what we're talking about and that's the banks lending to banks. So something that was an issue during 2008 because banks didn't want to lend to other banks because they weren't sure if they would get repaid. And this is something that you see could be a risk moving forward as well. Do you think that's the case, or is it more concern of their own balance sheets?
It's it's the same thing that happened in 2008. Yeah, and exactly as you said, banks didn't want to lend to other banks because they didn't have the money. Well, that's the same thing that happened in 2019. That why did interest rates go to 10% for a day in 2019? Well, because there weren't enough dollars going around. And so if you look at the money supply, you can look this up, or your viewers can look it up at the M2 money supply. It's been falling since April 2022. It's never fallen for this this long at a time, and the only reason that it hasn't crashed the system yet is because there's still extra money in the system, about $850 billion of it, and that's draining out. So 12, 13 weeks from now, I think it's going to be at zero. And then we're going to be in the same situation as 2008, 2019, 2020, 2024. It's always different as to how exactly the dominoes fall. And another one of them could be Japan, which is, people are speculating now they're going to end their yield curve control, which means their bond yields are about to rise significantly, and the yen is backed 80%, I think, by bonds. On the balance sheet of the Bank of Japan is, I think, 80% bonds. I could be wrong on that number, but it's some really, really big number. So when bonds fall, the other side of bonds, if a central bank owns bonds and they issue the currency, the other side of the bonds is the currency. So if the bonds fall, the currency falls. That could be another a major domino that causes some kind of hiccup or earthquake in the U.S. banking system. It's all connected. We're all in one really global banking system with different flavors, with different currencies, but it's all the same principles. It's all the same fractional reserve nonsense, and it's all going to fall together.
Yeah, I think that's something people just don't realize, that everything's connected. They look at their own country and say, "Oh, things are bad here," but it's like, well, they're bad everywhere because of this global economy and the global system that we're currently living in.
Yeah.
Yep. So you mentioned before that gold's at an all-time high, which is quite interesting, especially with equities going up. So I guess, why do you think we've seen gold increase? Is it retail investors? Is it institutional investors? Is it governments? And then from there, I'm assuming once currencies go down, you think gold's going to continue to go up, potentially similar to the 80s. Is that what you're thinking?
Well, gold is money, and currencies are derivatives of gold or silver. So when gold goes up, that means that currencies are going down, because the real money, the price matrix of the world, is in gold. It doesn't seem like that. People would say, "Oh, what are you talking about? I can't go to gold and buy food in a supermarket." But then I say, well, try to go to a supermarket with a wad of cash, or anything in your digital wallet or anything, or a credit card, and try to buy food with your currency when your currency can no longer buy gold. It won't work. That's not going to work. So the real money is gold, and the rest of the currencies are just gold derivatives, but to different degrees. The main gold derivative is the dollar, and other currencies are derivatives of the dollar, and that's how the pyramid works, right? You have gold, dollar, other currencies, debt on top of that, equities, other derivatives, etc. Or I should be going like this and not down, but it's inverted and it goes up. So who do I think is driving the gold market? It's not retail, because premiums are down. And the ETFs, the ones that retailers use to track the gold price to try to get dollar profits off of it, SLV and the GLD, their holdings in those ETFs have continued to fall. So it's not in the retail market, it's not in the physical markets, it's in the futures market. And who buys gold in the futures market? It's a ping pong between banks mostly, right? The ones who operate there are HSBC, Bank of America, JP Morgan. They buy and sell to each other, and the futures market is what's going up. So what's actually very surprising to me is, I said before, that gold really shouldn't be at new all-time highs with the money supply falling, and the fact that it is means that there's a lot of strength here, or a lot of weakness in currencies, and just wait to see what what happens when the Fed really does turn around. I think you're going to see gold going up by hundreds of dollars a day, silver going up by $3, $4, $5 a day. And that's really going to panic the central banks. They're not going to know what to do. They're not going to really be able to do anything, because they'll have to choose between saving their currencies and saving their banking systems. Either way, both of them are going to die, because a banking system can't survive with a currency that isn't worth anything. And a currency can't survive with a banking system where they just keep printing more money. So both of them are going to die. And the only thing that's going to be left is gold and silver anyway. And then we can restart a monetary system based on that after a lot of chaos. Don't ask me exactly how that works out. There's going to be a lot of problems, and the internet might go down in the meantime. Maybe not. We'll see. But that's what we're waiting for. That's the end game, and it means that gold and silver are no longer exchangeable for currencies, and that's what we're waiting for.
Okay. Are you surprised that, I guess, the banks are coming in and maybe bidding up these assets? Because normally, I guess, they've been sellers of precious metals.
No, but banks aren't sellers of precious metals on net. They also buy. They trade between themselves. Even central banks. A lot of people point to central banks. They say they're buying gold, and they're buying gold at rates that are records since the 1950s. That's true. They are. But if you look at the net holdings of gold by central banks since the 1950s, they haven't moved at all. Right? They were up in the 1950s, and then they kept selling and selling and selling until around 2000 with gold at a low, and then they started buying again. So central banks own about the same amount of gold they did 70 years ago, but they have a lot more currencies, a lot more fake money on their balance sheets. So this has to even out by the values of those fake currencies evening out to gold. And a lot of times what you see when this happens in a hyperinflationary country is that the central bank just lops off 3 zeros from the currency, and then they start over. So that could easily happen if, let's say, gold moves to $35,000 an ounce, and then the banking system collapses. You could see a reset at okay, so let's say, well, the dollar is now 35,000, and now we're going to go to 35 again and start over from 1971. We'll call it the new dollar, right? That's exactly what Weimar did. When they restarted a currency in 1923, they called it the Rentenmark. And I think it was like backed by land, which was backed by gold. There was some kind of scheme there where there were real assets behind it and some kind of chain. But what it was it was a 1 trillion to 1 reset in gold terms. So 1 Rentenmark was a trillion paper mark. So instead of lopping off 3 zeros, they lopped off 12. It's zero either way. So that's what we're waiting for. Exactly how many zeros are going to be lopped off, I don't know. I think it's going to be closer to 3 than 12, but who knows?
Yeah, it's really, really interesting to think. So I heard you talk about silver as well, and how you said that it's sort of it's in like a 90-year trend at the moment, and you think it's going to break out. I'm not sure if you can explain about that more.
A 90-year trend? I don't think I put it that way. I
Oh
was
no,
looking
sorry.
at, it was close. I was looking at a long-term chart of silver. First, I was looking at 5 years, and I drew a triangle, and then I was looking all the way back to 2011, and I drew a triangle there. A triangle means like the uptrend is going down and the bottom trend is going up, and it's meeting at a point, which means the price war between bulls and bears is getting more intense. And then I looked like at a 90-year chart. Yeah, that's what I said. It was a 90-year triangle, right? Going back to 1933 when silver was 25 cents an ounce. So I saw the triangle goes all the way back to there, right? 1933 is really, we talk about a reset a lot in these days. 1933 was a reset because it was when FDR, Franklin Delano Roosevelt, stole all the gold in the U.S., put it in Fort Knox, gave it to the Fed to issue papers or gave it to the Treasury to issue papers to the Fed, or exactly how it worked. And that was a currency reset from $21 an ounce to 35. So that's really when this current inflationary pyramid began in 1933, 34, right? When the entire gold supply was just pilfered by the government and given to the central bank. So is it surprising that the silver triangle has been playing itself out since then? Well, yeah, it's kind of it's breathtaking, but it's not surprising if you think about it logically. I mean, because silver is the money and the dollar is the derivative. So that once that triangle breaks out, that could also be, from a technical standpoint, be the end game. But technicals and fundamentals, that they eventually meet. They're on the same page. Not always. There's we know that fundamentals and technicals don't always match, but in the end, they always do.
That's a good point. So, Rafi, thanks for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Stay calm. Don't worry about daily price movements. Don't rely on ETFs. Don't rely on futures contracts. Don't try to make a profit in currency terms using gold and silver. You can, if you like that game, play it. I mean, if you enjoy it, but don't count on dollar profits or pound profits or currency profits to save you from an end game. You'll need physical, because when the currencies go, there's going to be nothing else to spend except the actual coins in your pocket for a while. And then after that, they'll figure out a new currency system. That's going to take some time. In the meantime, you need to live and survive. And you'll be able to buy a lot with physical. So the first thing you need to do is get physical silver. and then some physical gold for what I say is physical silver for during the end game and physical gold for after, because gold will be more stable, though silver will be more important when there's no money that works.
Yeah, it's a good point. So yeah, you don't want to be carrying lots of gold around with you either. I'm sure during that period, it's easier to have silver. But yeah, thanks again for your time. Appreciate it. If anyone wanted to find out more about your work, we mentioned Seeking Alpha. Is that the best place at the moment for your newsletter?
Yeah. Check out my YouTube channel at Rafi Faber. You can Google the Endgame Investor. You'll find me on Seeking Alpha, though for tax reasons, I'm moving to Substack. I have some stuff on Substack, endgameinvestor.substack.com. It's more philosophical stuff, and it'll give you a very good basis and a conceptual basis in why gold and silver. If you can't see exactly why it's money, that will explain why. And I'm going to move my investment newsletter over there soon. By the end of for 2024, it should be there, but right now it's on Seeking Alpha. You can sign up there if you want. And I write about 3 or 4 times a week, usually 4 times a week, with a weekend report. And you can follow me on Twitter. You can sign up to be on Patreon, where I give a more religious angle on what's going on, talk about the Torah and the Bible and its views on monetary policy. And there are many. Yeah, that's where I am these days.
Perfect. I'll put it all in the description below, but thanks again for your time.
Thank you, Anthony.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.